Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to dive in and look at 3 undervalued aristocrats to buy now. Dividend aristocrats are companies in the S&P 500 that have raised their dividends for at least 25 years or more. What's even better, guys, that these discounted dividend companies that I'm going to show you are under $100 each. All these dividend companies have been rewarding their investors for at least 27 years. So sit back, grab your favorite drink, enjoy the video. Just remember that this is not financial advice. This is just me sharing. Also, do me a huge favor, hit that like button, subscribe if you haven't done so. It means the world to me. And lastly, click on that notification bell so you don't miss out on any of the videos that I put out. With that said, let's take a look at these companies. So the first one I want to talk about is NextEra Energy. The ticker symbol is NEE. This is a company that engages in renewable energy. What they do is they produce electricity from clean and renewable sources. So if you're not familiar about this company, definitely go take a look at it. Some of the key things: number one in the electricity and gas utility industry, a 98% reduction in dependency on oil since 2001, and then you got all these other ones in here. So if we swing over here, operation 67, market cap is of 151 billion. And 165 billion total assets. And you can see here, what I like about this is has a long-term track record of delivering shareholder value. So you can see the CAGR, adjusting earnings per share, all the way down from 07 on to 22. You can see the upward trend. The dividend yield per share also has been increasing. 15 years of total shareholder return, 480% outperformed versus the S&P 500 utilities. Now if we swing over to tip ranks at the time of this video, it is at 89. They feel that it's a 20% upside. I'm sorry, at the time of this video is 74. They feel that it's a 20% upside to about 89. The high would be 94, the average of 89, and the low of 84. The rating is a strong buy, about 5 buy, 0 sell, and 1 hold. Now if we swing to Simply Safe Dividend, based on their dividend safety score, they're rated as a 99, which is very safe. The dividend yield is 2.51, and then again it's a market cap. Looking over the key metrics, you can see payout ratio is about 58%, which is low. Forward payout ratio is about 59, again, which is also low. During the recession, they have increased their dividend. Looking at the dividend growth, you can see the last 20 years, 9%. The last 5 years, about 12%, and the latest is 10. Dividend streak of 27 years, consecutive increases, and more importantly, uninterrupted dividend streak without a reduction for 27 years. If you get this thing, you're going to get paid by quarterly in the months of March, June, September, and December, and then your annual payout would be $1.87 per share. Looking at it, it is undervalued. Forward PE ratio is right here. 52-week range is like close to the low 52, and then you got your PE ratio, which is a little bit higher than the utilities. And financials, you can see here is the payout ratio, free cash flow ratio. You got the sales growth, earnings per share, total sales, outstanding sales right there, and then return on equity, return on investment capital, free cash flow margin, and operational margin. Now if we look at Google, you can see for the 5-year return, it's up 74%. Year to date, it's just down 11%, and then the year is 6%. So for 5 years, if you would have invested on this company for 5 years, you would have been up 74. Now if we swing to Seeking Alpha, based on the 10-year mark, you would have been up 271%. So if you would have invested on this company 10 years ago, you would have been up 271. Now if we go swing to alpha spread, based on their intrinsic value, they rate it as undervalued. And then if you look down at the fundamentals, you can see the revenue is about 24 billion. Operation income is 7 billion. Net income is about 6 billion. Operation cash flow, free cash flow right here. And then you got your balance sheet of assets about 165, and then you got your liabilities of 122. And then you can see right here, efficiency, net margin, operation margin, return on equity 17%, ROA 4%, and all of that. The next one on the list is Pentair. The ticker symbol is PNR. This is a company that engages in the provision of water solutions for residential, commercial, industrial. So definitely take a look at this. They have products relating to the pool and water. Now if we go to their presentation, you can see sales is about 4 billion. Dividend Aristocrat for 47 years. If we swing a little bit more to here, strong financial results in the quarter. Sales growth have growth of 3%, and then you got your adjusted EPS have increased. So you can see it here. I like the fact that each quarter they have increased, either their sales or adjusted EPS or segment income. Now, if we swing to Yahoo Finance, I wanted to see how the performance of this company is. Year to date, it is performing much better than the S&P 500. If you look at the 5-year mark, S&P 500 is slightly doing a little bit better than the PNR. Now, if we go to tip ranks based on their smart score, they rated as a 9, which is outperformed. Now, if you look over here, hedge funds have increased their shares, and you can see consensus of moderate buy with a a lot of upside, 64% upside. If you go over here, you could see a moderate buy, 14 of them, 9 buy, 3 hold, 0 sell, with the high of 77, the average is 64, and then the low of 39. The upside is not as much. However, if you go to Simply Safe Dividend based on their dividend safety score, they rated as very safe. The dividend yield is 1.36, and then you can see the market cap. And then looking over, you can see payout ratio is 23. Forward payout ratio is also 23. During the recession, they have increased their dividend streak of 46 years without a reduction, guys. Pretty solid in my opinion. The growth is not as much as I would like. Last 20 years, 4%. Last 5 years, -9. And then the latest is 4%. However, again, uninterrupted dividend streak of 46 without a reduction. Dividend growth of 46 without a reduction. And then if you want to know when you're going to get paid, if you decide to invest in this company, you get paid quarterly in the months of February, May, August, and November. Annual payout is 88 per share. And then your ex-dividend date is July 20th, with 17 days away. Could be overvalued based on Simply Safe Dividend. You got your payout ratio right here. And then you got your a little bit higher on the 52-week range. P ratio 17, and industrial stat. Yeah. And then a quick look at some of the stats. You got the forward cash payout ratio, earnings payout ratio, earnings per share, forward payout ratio, earnings per share growth, sales growth, total sales in billion, and then return on investment capital, return on equity. Now, if we go to Seeking Alpha, based on the 10-year performance, 63%. So you would have been up 63% if you even invested in this company. And then the last one I want to talk about is Medtronic. The ticker symbol is MDT. This is a company that engages in development, manufacture, sale of device-based medical therapies. So take a look at this company. This is a company that I've been looking at for the past couple of months. Now, if we go to Google, you can see the 5-year return is up only 1%. And then if you go to tip ranks, based on their smart score, they're rated as a 10. Consensus rated as a moderate buy with a 28% upside. And then hedge funds have increased their share for the last quarter. 5-year return of this one with up to 15%. And then if you go over here, based on Simply Safe Dividend, based on their dividend safety score, they're rated as a 99, which is safe. The dividend yield is 3.13, and then the market cap is 117 billion. Looking at the key metrics, you can see payout ratio is about 51, forward payout ratio is 55, 45 years of dividend streak without a reduction. They have increased their dividend during the recession. Dividend growth the last 20 years is 13%. The last 5 years it's up 8%. And then if you look down over here, 45 years without a reduction and 45 years of increases. Payment details, you get paid quarterly in the months of January, April, July, and October with the annual payout of $2.76 per share. And then it may be undervalued as well. Looking at some of the sector PE ratio comparison, 17 to about the healthcare. And then you got your other ones here, free cash flow, earnings per share, sales growth, total sales per billion, return on investment capital, and then return on equity. Now if we swing over to an alpha spread, you can see undervalued at 99%. You can see the fundamentals right here, 31%, 31 billion revenue, 6 billion operation income, net income of 3 billion, and then you got your free cash flow, and then your balance sheet of assets of 90 billion versus 39 liabilities. All right, guys, but that's it. I think these are great companies to add to your portfolio. If you want to do a little bit more research, which I suggest, definitely do that. Also, make sure you go check out the other companies, other videos that I've created. It might be hopefully something that you would like. As always, please remember, stay cool, keep investing, and I'll catch you guys in the next video. Right? Take care. Aloha.